Chapter 8. Do your taxes. As you accumulate assets and increase your wealth, it is important to pay the correct amount of taxes and no more. Let's go over some basic tax form terminology to set up your financial future. Form 1040. Who is this for? Everyone. This is where you tally your income and deductions to calculate how much tax you owe. Are there variations of this form? Form 1040. For everyone. You can itemize deductions and claim all allowable credits. This is the longest 1040 at a nimble yet dense 2 pages. Form 1040A. Phasing out 2018 returns will use the 1040 exclusively alongside newfound Schedule 1 through 6 supplements in place of the full 1040. Simpler version of the 1040 that you can use if your taxable income is below $100,000, 2018. You cannot itemize deductions, but you can claim popular tax credits, deduct student loan interest, deduct IRA contributions, and more. Form 1040 Easy. Phasing out. 2018 returns will use the 1040 exclusively alongside newfound Schedule 1 through 6 supplements in place of the full 1040. Many taxpayers will not need to file schedules. This is the simplest version of the 1040 at only 1 page long. This form is for individuals under 65 with a taxable income under $100,000 and interest income under $1,500 who will not claim any credits or itemized deductions besides the earned income credit, which we'll talk more about tax credits and itemized deductions later. Can I fill out this form? Yes, you can download any version of the 1040 directly from the IRS online. Most boxes in your tax return explain themselves and walk you through calculating your tax liability. Just plug in income as reported in some of the following forms and claim your deductions. However, each form also has its own respective instructions to help you through any complex directions or calculations. Once you finish the math in your return, you can file it online directly to the IRS or mail it into a local individual processing center. You can pay taxes with an electronic funds withdrawal, direct deposit, credit or debit card, mailed check, or electronic federal tax payment. If you overpay your yearly taxes through withholding or estimated tax payments, you can receive your refund through direct deposit or mailed check. Form W-2. Who is this for? Everyone. If you have a job, your employer will give you this document annually to report your gross income, wages, salaries, tips, etc., alongside any federal income, state and local income, Social Security, and Medicare taxes withheld from your pay. The government also uses this form to report non-taxable combat pay. Are there any variations of this form? Form W-2G, used to report certain gambling winnings to ensure taxes are paid on them. Form W-3. This form contains the same information as your W-2. Your employer completes and sends the form to the IRS to validate your federal tax return. Can I fill out this form? Your employer fills out this form and you can use its information in your 1040 return. Form 1099. Who is this for? Everyone. The IRS uses this form to track large payments outside of your job alongside payments to independent contractors. Are there variations of this form? There are currently 20 1099 variations. The most common and applicable variants are Form 1099 Div. When you receive additional dividend payments, your broker will send you and the IRS this statement every year. You earn more than $10 through dividend income. We will talk more about growing your wealth through dividends in Chapter 15 and beyond. These dividends are included in your adjusted gross income. Form 1099 Miss. If you run a business, you can use this general 1099 variant to report miscellaneous payments over $600 to others for non-employee work and compensation. You can file this form if you make a large payment to an independent contractor for work, but you will generally only receive this when someone else pays you. Form 1099-B. Your broker will send you this report yearly to state realized, sold, capital gains or losses that you transferred to your 1040 schedule supplement Schedule D. This supplement separates your short and long-term capital gains to streamline your tax liability calculations. Your commodity broker should also send a Form 1099-B to you, stating marked-to-market unrealized profits and losses from the year's commodity contracts. Form 1099-INT. You will receive this form from any bank, broker, dealer, government, or other institution that pays you over $10 in interest income. This income could come from bond interest, checking and savings account interest, treasury bills, and more. As stated earlier, treasury bills are exempt from state and local federal income tax, whereas municipal bonds are exempt from federal income tax alongside state income tax in many cases. Aside from these lower interest-bearing investments, the government includes taxable interest income in your adjusted gross income. Interest and other ordinary dividends from Form 1099 Div are tallied on Form 1040 Supplement Schedule B, which you can also use to report all of your taxable interest and dividends, even when you reinvest dividends. Form 1099-Q. You receive this form at the end of any year you take a distribution out of a 529 college savings plan or Coverdell ESA. You can match this report up with your receipts for qualified educational expenses and 1098-T to qualify your withdrawals. We will talk about the 1098-T soon. If the distribution amount exceeds qualified educational expenses, then you must report the excess as other income on your 1040. Form 1099-R. Employer-sponsored retirement plans and other financial institutions issue this form to report account rollovers and withdrawals over $10. You receive this report if you withdraw cash from annuities, profit-sharing plans, retirement plans, IRAs, insurance contracts, or pensions. Institution direct or withdrawn and reinvested within 60-day rollovers in a retirement plan or IRA are not taxable, whereas retirement plan distributions, IRA distributions, annuities, and more are taxable. 1099-R should state the amount of a distribution that is taxable alongside any federal income tax already withheld. Can I fill out this form? These forms help ensure Americans pay the right amount of taxes by sending both the IRS and you a copy of large payments or some investment income to reference when you file your return. You will generally only use this form as a reference for when you fill out your taxes to ensure you calculate tax liabilities correctly. Since businesses use 1099 forms to issue 1099 forms to both the IRS and you need not submit your 1099 statements to the IRS. Form 1098. Who is this for? Everyone. Variations of this form range from reporting mortgage interest to donating planes. Are there variations of this form? Form 1098. When you make mortgage interest payments of at least $600 in a given year, your financial institution will issue this report. You can use this information in your Schedule A to itemize deductions when your total itemizable deductions exceed the standard deduction. We will talk more about itemizing deductions soon. Form 1098-T. Your college uses this form to report tuition and other educational fees you paid over the year. You can use this to validate your qualified college savings plan distributions and education credits, which we talk about soon. Form 1098-E. If you receive at least $600 of student loan interest, then you file this form and provide a statement to the borrower. Form 1098-C. If you can use this to account for any tax-deductible donations of motor vehicles, boats, and airplanes. Form 1098-Q. You send this form to the IRS and beneficiary to report when you issue a qualifying longevity annuity contract. This contract provides guaranteed monthly payments until death for elder investors, shielding them from stock market downturns. Can I fill out this form? You receive this form from institutions, companies, private organizations, etc. as a record of large payments. As an informational reference to help you with your return, you neither fill out these forms nor send them to the IRS. Form W-4. Who is this for? Everyone. If you get a new job, your employer should ask you to fill out this form alongside its local state counterpart. Are there variants of this form? Form W-4. This is your employee's withholding allowance certificate. It tells your employer how much to withhold from your paychecks to pay to the federal income taxes. You receive this report and its state equivalents with you fill them with simple information about your personal allowances and deductions which you claim on your 1040 return. Simply follow the step-by-step instructions in this document to ensure the right amounts of tax gets withheld from your pay. Form NC4, DA4, M4, etc. State W4 equivalents. This tells your employer how much state and local income tax to withhold from your paychecks. Note that some states like Oregon and South Carolina use the federal W4 forms for state taxes. Simply write state at the top of the federal W4 when you submit it. For states such as South Dakota and Wyoming that do not charge state income taxes, you need not file a state W4 equivalent. 2018. Can I fill out this form? You fill out this form to help your employer determine how much money gets withheld from your paychecks. By accurately completing your W-4, your employer should withhold cash from your paycheck that equals your federal income, state income, local income, Social Security, and Medicare tax liability at the end of the year. If you get a refund, then your employer withheld too much and you should alter your yearly W-4 and state equivalent. If you pay a tax bill, then your employer withheld too little and you should alter your yearly W-4 and state equivalent. You can ask your employer to withhold additional taxes from your pay in the W-4 box 6, additional amount, or form W-4V so that you do not have an unexpected tax bill at the end of the year. If you have multiple jobs, ensure that your employer does not withhold too much Social Security or Medicare tax from your paychecks. These taxes should be withheld at 6.2% and 1.45% respectively, with taxable limits up to $128,400 times 0.062 tax rate equals $7,960.80 maximum amount paid for Social Security taxes, and no limit for the 1.45% Medicare tax, which adds an additional 0.9% after the first $200,000 of taxable income. If you have more than $7,960.80 withheld for Social Security from all your jobs, you can file Form 843 at the end of the year for a Social Security overpayment refund. 2018 maximum and tax percentages. When you file your 1040 return using electronic free fileable forms with direct deposit, you are guaranteed the fastest possible processing time by the IRS. As of 2018, you can even use free commercial tax preparation software from the IRS if your income is below $66,000 through the e-file program. You can do your own taxes. The best way to learn about taxes is to simply follow the IRS instructions and submit your own return to the best of your ability. When you file your taxes, you have the option to take a standard deduction or to itemize deductions against your taxable income. The standard deduction against income is $12,000 for individuals, $18,000 for heads of household, and $24,000 for married couples filing jointly and widowers in 2018. If your itemized deductions exceed the standard deduction, claim them. However, it is much easier and efficient to take a standard deduction if you do not have any large itemizable deductions. If you think you will deduct more by itemizing deductions, use IRS Schedule A to supplement your 1040. Americans with larger incomes generally itemize deductions more than others. Of those who do itemize, the most popular deductions are state and local income taxes, mortgage interest, and charitable contributions. A 2017 White House study reported that 90% of taxpayers plan to claim the standard deduction. You can itemize state and local property taxes, maximum $10,000, or $5,000 if married filing separately in 2018, sales tax or state and local income taxes, home mortgage interest, casualty and theft losses due to federally declared disaster, recorded charitable contributions, medical and dental expenses that exceed 7.5 to 10% of your AGI, percentage changes relatively frequently, investment interest expenses, for example, fees and advising services, as long as they are lower than investment income, and miscellaneous deductions. You can deduct the amount of these expenses that exceed 2% of your AGI. unreimbursed business expenses, expenses for uniforms, tax preparation fees, business use of your home, subscriptions to professional journals, and job hunting expenses. Phasing out. Miscellaneous deductions are no longer allowed in 2018. This affects you as an investor and strengthens active trading status, as we will explore in Chapter 20. In addition to the standard deduction, you may qualify for the refundable Earned Income Credit. The amount of the Earned Income Credit depends on your taxable earned income and the number of children. The EIC's maximum value in 2018 is number of qualifying children, and then the chart has 0, 1, 2, and then 3 or more. And in that order, the maximum value is $519, $3,461, $5,716, and $6,431. The chart below shows the value of the EIC depending on your income and the number of qualifying children. The data uses the 2017 metrics for maximum refundable credit amounts and income limitations, which we'll talk about soon. The percentage phase-ins and phase-outs change the value of your EIC when your AGI falls outside of the maximum credit income range. For example, a 45% phase-in increases the value of the credit by 45 cents for every dollar of taxable earned income up to the maximum credit limit. After passing the income threshold for your maximum credit, the value of the EIC fades out in the same manner. A 21.06% phase-out will decrease the value of the credit by 21.06 cents for every surplus tax dollar of earned income. Then we have our graph for the EIC credit. We see the credit amount. On the left-hand side, it ranges from $0 up to $6,431. And then we see the phase-ins and the phase-outs. And you can see the plateaus and the curves up with the percentage phase-ins and the curves down with the percentage phase-outs. And that's based on our x-axis, which shows income, adjusted gross income ranging from 0 to $49,194. And then you can see where you'll have the maximum amount of credit, and as long as you're within the range, it's just going to help you, can't hurt. From highest to lowest maximum EIC, we see 3 children or more, 2 children, 1 child, and no children. For married couples filing jointly, the credit begins to phase out at an income $5,690 higher than shown. To claim the EIC, you must have a Social Security number and your spouse if filing jointly. Claim qualifying children on Form 1040 Supplements Schedule EIC. This document walks you through reporting your children. Your children must have Social Security numbers. We'll talk more about this form and child qualification soon. Have earned income from employers, owning a farm, running a business. Not file separately if married. Be a U.S. citizen or resident alien all year. Exemptions available for non-resident aliens married to U.S. citizens or resident aliens. Not be another person's qualifying child. Not report foreign earned income through Form 2555 or 2555EZ. Have a qualifying child defined soon. Or be at least 25 but under 65 at the end of the year. Live in the U.S. for more than half the year, and not be a dependent, as defined soon, and have an earned income and AGI lower than the following statistics, which change based on the number of qualifying children you claim. Note that these 2018 maximums change each year and are simply at the end of the phase-out period shown in the graph above. Then we have a graph which shows filing status on the left. So we have single, head of household, or widowed. Then married filing jointly. And then we have qualifying children claimed. And it goes from 0, 1, 2, and 3 or more. And then the income limits and the phase-out maximum qualifications from 0 to 3 or more for single, head, household, widow, etc. is $15,270, $40,320, $45,802, and $49,194. Then for married filing jointly in that same order of children, it's $20,950, $46,010, $51,492, and $54,884. In addition to these income limitations, your investment income must be $3,500 or less for the tax year 2018 limit. Investment income includes interest payments, dividends, capital gains, and any other profit made through an investment vehicle that you realize. Once you start accumulating assets to pay dividends, this investment income limitation may stop you from claiming the EIC. However, making more money through assets is good. You can still claim the EIC in years where you realize few capital gains as long as you meet the above criteria. This criteria is a great way for you to lower your initial tax liability while you start accumulating assets, freeing up more cash to invest. For reference, a dependent can be a qualifying child or a qualifying relative, for example, an older or younger family member that you support. And all dependents must be a U.S. citizen, a U.S. national, a U.S. resident, or a resident of Canada or Mexico, be claimed as a dependent on only one U.S. tax return per year, not file a tax return without claiming dependents, and not file a joint return. Additionally, a qualifying child meets the following qualifications and is age qualifications: under age 19 at the end of the year, under your age, and under the age of your spouse if filing jointly, a full-time student during at least 5 months of the year, under age 24 at the end of the year, and younger than you or your spouse if filing jointly, or permanently and totally disabled at any time during the year at any age. Relationship qualifications: biological child, stepchild, eligible foster child, adopted child, and any other child placed with you for legal adoption by an authorized adoption agency or a descendant of any of these individuals, or your siblings, half-sibling, step-sibling, or descendant of any of these individuals. Residency qualifications: living with you or your spouse is filing. Whoa. Okay. I'm gonna try that again. Residency qualifications: living with you or your spouse if filing jointly for more than half the year. Joint return qualifications: not filing a joint return or only filing a joint return to claim a refund and is not required to file. Financial support qualifications: parents provide the dependent with financial support equal to or greater than half of their annual income. These qualifications are key for claiming the child tax credit, child and dependent care credit, educational credits, and more. For both Roth IRAs and the Earned Income Credit, remember that earned income only includes taxable wages earned from an employer or income from running a business or farm. Your stock dividends and long-term asset sales do not count. For the EIC, you can choose to include the entirety of your non-taxable combat pay in your taxable earned income to claim the EIC if this increases your refund or reduces your tax liability. If your spouse also has non-taxable combat pay, you can both choose which way is best for you. As you grow your net worth and dividend income through asset accumulation and compound interest, this credit may phase out of your reach. However, it can still help to get you off your feet by freeing up money to invest in the market early on, the best time to invest. Alongside the Earned Income Credit, you can claim the Saver's Tax Credit when you contribute to your retirement plan. To qualify for this great credit, you must be 18 or older, not be a full-time student, and not be claimed as another's dependent. Once you meet these qualifications, simply make contributions to any retirement plan, IRA, 401k, employer plan, personal ABLE account, etc. We'll talk more about ABLE accounts soon. Your contribution must be made in the tax year that you file for. The maximum credit amount is $2,000, $4,000 if married filing jointly, directly off your tax bill. You can calculate your credit by simply multiplying your qualifying contributions, not rollovers, by your credit rate as determined based on your adjusted gross income. Remember that retirement plan contributions decrease your AGI too. Then we have a chart, and it's the Savers Tax Credit rate in 2019 for single, married, filing separately, or qualifying widowers. We have a first column, second column is married filing jointly, third column is head of household, and then it gives specific AGIs, and those AGIs correspond to what percent of your contribution to a qualified plan counts as part of the Savers Tax Credit. You guys can look at this chart in the book, but you just reference where you are, what class you're in, and then as your AGI increases, the percentage of your contribution that you can attribute to the Savers Tax Credit decreases. So starts at 50% and then phases out to 0% once you get over that income limitation. So good reference right here just for you. I'm not going to read the entire chart for you because it is just a lot of numbers. If you meet an income limitation above, then the government wants to help you save for retirement. Use Form 1040, Supplement Form 8880 to calculate your Savers Tax Credit. This can be a great way to free up extra cash early on to put in pre-tax plans like Roth IRAs or 529 plans. The tuition and fees deduction for qualified higher education expenses is a separate deduction directly from your taxable income, even if you take the standard deduction. If you or your dependent child pay for college tuition and mandatory fees like textbooks, you can take a direct deduction up to $4,000 of such expenses as long as your MAGI is under $80,000, $160,000 if married filing jointly, or up to $2,000 if your MAGI is under $90,000, $180,000 jointly, 2018. You cannot claim the tuition and fees deduction as well as an education credit. Additionally, you cannot take this deduction or either of the following tax credits if you are a dependent, married filing separately, or classified as a non-resident alien. We will talk about dependency soon. The two educational credits available are the American Opportunity Tax Credit, AOTC, a maximum annual credit of $2,500 for qualified educational expenses paid for the first 4 years of higher education. To claim this credit, you, your child, or your spouse must be pursuing a degree or other recognized education credential, be enrolled at least half-time for at least one academic period beginning in the tax year, not have finished the first 4 years of higher education at the beginning of the tax year, not have claimed the AOTC or the former Hope credit for more than 4 tax years, and not have a felony drug conviction at the end of the tax year. Only educational credit or deductions with this requirement. You can claim multiple credits for multiple children in college as a parent. However, you cannot claim the credit if you are a dependent. In other words, you do not get credit for your parents paying for college, but you can claim your children. The American Opportunity Credit value is 100% of the first $2,000 of qualified educational expenses, plus 25% of the next $2,000 of qualified educational expenses, or $2,500 maximum. Where qualified educational expenses are tuition, fees, and related required fees for enrollment, but are not room and board, insurance, medical expenses including student health fees, transportation, or similar personal living or family expenses. The American Opportunity Credit also uniquely considers books and other required supplies and course equipment as a qualified educational expense, unlike traditional tax definitions and other educational credits and deductions. These costs are included in your credit calculation no matter who sells the supplies. In other words, you can buy a textbook online as a qualified expense. Note that you cannot claim this credit at all if your MAGI exceeds $90,000 individually or $180,000 jointly, and your credit amount gradually decreases as you near these thresholds. You will get a refund of 40% of your credit, up to $1,000, if the American Opportunity Credit lowers your tax liability below zero. And the Lifetime Learning Credit. The Lifetime Learning Credit is worth 20% of the first $10,000 of qualified educational expenses paid by you, your spouse, or a student who you claim as a dependent. So, the 2018 maximum of $2,000 sits $500 lower than the AOTC's maximum, and you must spend more than twice as much on tuition fees and mandatory expenses for this non-refundable tax credit. You cannot claim the lifetime learning credit if your MAGI is above $66,000 individually or $132,000 if you are married filing jointly, and you will receive reduced benefits as you near this threshold. Additionally, you cannot claim more than one lifetime learning credit per return. The lifetime learning credit is more flexible than the AOTC since it can be used for all years of post-secondary education and for courses to acquire or improve job skills rather than the first 4 years exclusively. In other words, it's usable in graduate school. You are not required to pursue a degree or other recognized educational credit for the lifetime learning credit, so you can study industry or job-specific classes outside of an accredited curriculum-based course and claim this tax credit. Note that the tuition and fees deduction can also be used for unlimited years of post-secondary education, but this deduction requires you to take accredited courses at federally recognized institutions. Use IRS Form 8863 to claim these two educational credits, or Form 8917 to claim the tuition and fees deduction. Both of these forms complement your 1040. However, the IRS will not let you spend 529 plan or covered out ESA distributions on these tax credits or deduction. The same expenses cannot be used for two tax savings. To qualify for a tax credit or deduction, you must spend money outside of a college savings plan on qualified educational expenses. Let's look at a quick example to make sure you get the most out of your college savings plan and tax deductions. The following statistics come from Harvard University's published 2018-2019 expected cost of attendance. Tuition, $46,340. Fees, $4,080. Room, $10,609. Board, $6,551. Estimated personal expenses, including $800 to $1,200 for books, $4,070. Estimated travel costs, $0 to $5,000. Health insurance, unless you are covered under your family's health plan, $3,364. Sum, assuming no travel costs, $75,014. Now that you're in Harvard, let's look at how you can pay for your education. Let's say your parents or you contribute to both a 529 college savings plan and a covered out ESA. If your account is significantly overfunded and can easily pay for all 4 years of college, congratulations! You may not want to claim educational credits or tuition deductions at all, as you cannot spend tax-benefited college fund investments on qualified educational expenses for credits or deductions. You can claim a credit or deduction only if you spend other cash from either income, savings, or other normally taxed assets. This is your ideal scenario wherein you put enough of your college money into assets that in turn, over the long run, pay for your full college costs. If you're in this scenario, consider the taxes you can avoid by following a college budget, coming up soon, wherein you spend normally taxed cash or investments on tuition to claim deductions which could outweigh 529 unqualified distribution penalties and income taxes by lowering your annual tax liabilities. If you know that you'll have an extra 16 grand in a 529 plan by the time your child finishes college, then you could take a $4,000 distribution from the account every year and claim the tuition and fees deduction or American Opportunity Tax Credit if you have multiple children in college, increasing your overall yearly tax savings, as we will explore soon. The IRS waives the 10% penalty if you do claim these credits or deductions, only charging you income taxes on earnings. However, you can avoid these taxes altogether by paying for one child's entire education and then rolling over an account to another child, thereby allowing your investments to continue growing tax-free to pay for your next child's college. Nonetheless, please do not let fear of fees stop you from contributing more than $250 a month to your child's college fund, as long as you balance your investments across your other retirement funds and savings goal assets, or more than $363.33 adjusted for inflation, as we will talk about soon. $300,056, $75,014 times 4 years is a lot of money to pay, assuming you get no financial aid scholarships. Let's say you put away $250 a month for your child, totaling $3,000 a year, from the day your child is born to the time they reach 18 and finish high school. Since you know that your kid is the best, you also decide to deposit an initial investment of $3,000 in your child's future early on, so that the principal can have the most time possible to compound in value. In the earlier graph comparing college inflation, and U.S. market index performance, we see that the average inflation over the 34 cited years for private, nonprofit, 4-year schools is 5.45% and 5.45588% for public 4-year schools. Knowing this, you decide to put your $250 monthly investments and initial $3,000 deposit in a NASDAQ Composite Tracking ETF, which averages a 13.9097% return during this 34-year period. We will talk about ETFs in Chapter 17. However, you slowly moved some of your money into corporate bonds as your child went through high school to decrease the risk of your capital significantly dropping in the market right before you need to spend it. Because of this intelligent diversification and risk avoidance, you decide to move a quarter of your portfolio into bonds that average a 5% return for the remainder of your child's high school education every year, 25% during the first year, 50% during the second, and so on until you are fully in bonds during your child's senior year. This is a fairly conservative portfolio management strategy that many embrace when they fear that the overall market may be overvalued. You may decide to leave your investments in riskier stocks if you see significantly higher potential returns in equities versus corporate bonds, or vice versa in uncertain markets. Using this strategy, your average predicted return turns out to be around 13.91% for the first 14 years of NASDAQ investing, at 11.6825, 9.4550, 7.2275, and 5% for the last 4 years. Your $250 a month, totaling $57,000 after 18 years plus your initial deposit, turns into $204,908.21 using the compound interest calculator formula from earlier in this book, using percentage numbers from college inflation, and U.S. market performance graph in Chapter 7 that looks at the average annual NASDAQ composite return from 1985 to 2018. Our final portfolio value is calculated assuming minimal long-term management with an exclusively index tracking investments and yearly interest compounding. Due to short-term index unpredictability, you can use yearly compounding to account for monthly downtrend buys and uptrend buys, averaging short-term monthly gains and losses into an overall yearly average percent gain, which we will talk more about indices in Chapter 16. Great job! You have just under $205,000. The College Board lists the following statistics about the comprehensive 2018 to 2019 yearly cost of college. These figures include tuition and fees, on-campus room and board, books and supplies, transportation, and other expenses, also known as everything your terrific 529 plan and covered out ESA will pay for. Four-year private nonprofit college average cost is $52,500 times 4 years is $210,000. Four-year public college in-state average cost is $25,890 times 4 years is $103,560. Four-year public college out-of-state average cost is $41,950 times 4 years is $167,800. Since we are looking at today's college costs, we must remember that you saved $250 in past money in this example. 18 years ago, $250 had the same buying power as $363.33 today. Therefore, in today's 2018 dollars, you would put away $363 a month, or $363.33 times 12 months equals $4,359.96 a year for the same savings plan. As time goes on, the actual purchasing power of the cash you invest decreases, while your earlier investments accrue more interest. By investing a little over $4,000 in today's dollars 18 years ago, you can now fully pay for an average in-state and out-of-state public four-year college and need only pay about $5,000 for an average private nonprofit degree. By considering how much college will cost in the future, you can figure out how much to put away today. Note that transportation and travel, college supplies, and other expenses included in the above cost figures are more likely to inflate at the standard consumer price index inflation rates rather than higher college inflation rates, which are used in the following calculations to extrapolate potential future college costs. However, textbook prices rise significantly faster than standard inflation. Since professors dictate exactly which book and volume of said book students need, they artificially allow publishers to increase prices to absurd levels, since students generally have no choice but to purchase the required texts, which are often updated yearly to keep new books in circulation. With that said, many online used booksellers help students find cheaper textbooks to save on college costs. The following calculations use the standard college inflation rate for expenses beyond tuition fees, room, and board because of overall hastened increases in textbook prices, but lower increases in other supplies, transportation, computer technology, and other expenses. Using the current 5.45% average private college inflation rate and 5.45588% average public college inflation rate from our Chapter 7 graph, we can extrapolate the following future compounding college costs after 18 years. Private, $52,500 times 1.0545 to the power of 18 equals $136,457.62 times 4 years equals $545,830.48 in future 2036 dollars. Public in-state, $25,890 times 1.054588 to the power of 18 equals $67,360.68 times 4 years equals $269,442.72 in future 2036 dollars. And then public out of state, $41,950 times 1.0545588 to the power of 18 equals $109,145.63 times 4 years equals $436,582.52 future 2036 dollars. You may want to recompute these figures with current expected college costs and inflation rates, data readily available from the College Board. These calculations assume that college rates in America will keep rising at their historical rates for the next 18 years after you have a child. Many individuals suspect that the United States is in a higher education bubble. This macro interpretation of the American economy, debt-fueled education system, argues against students taking on too much debt to get potentially unworthwhile degrees at abhorrent prices. However, you do not need to worry much about debt since you already have $205,000 in today's dollars to spend on your child's college after investing for 18 years. Back to Harvard, we see a total projected annual cost of $75,000, 14 cents a year, or $300,000 and $56 for 4 years. You will have to pay $95,147.76, 300,056 costs minus $204,908.21 from assets for a Harvard degree, assuming we do not may invest more cash early on, the best time to invest, or take riskier, higher returning investments. To best balance tax-deferred college savings investments, tax deductions, tax credits, personal spending, and student aid, we can follow this spending table. Then we have a table paying for Harvard. We have tuition and fees, which is $50,420. Room and board, which is $17,160. Estimated personal expenses, including $800 to $1,200 for books, which is $4,070. Travel costs, estimate from $0 to $5,000. And health insurance, unless you're under your family's health plan, which is $3,364. Each of those columns apply to every single year, and then we break it up in the chart freshman year, sophomore year, junior year, and senior year as separate sections. So in freshman year, for tuition and fees, you can pay $46,420 from your 529 plan or ESA, and then pay $4,000 cash and claim the tuition and fees deduction or AOTC. For room and board, you can pay the full $17,160 from the 529 plan or ESA. And for the personal expenses, you can pay about $2,070 or more from a 529 plan or ESA to cover qualified expenses, and then pay around $2,000 cash for other miscellaneous expenses. Travel costs, we're just going to say varies for different students. We don't know. Health insurance, you have to pay from savings as it is not a qualified educational expense. So for freshman year, you end up spending $65,650 from your college assets and about $9,364 from savings, cash, job, etc. Pretty much the same pattern, same setup for sophomore year. Junior year, we start running out of money, so we have to figure out how to allocate it. Essentially, we have the same setup with tuition and fees, where we're paying to claim those special tuition and fees deductions, or the AOTC, and we're also paying the rest from our 529 plan or ESA. Then for room and board, we kind of run out of money, so we spend our remaining $11,921.07 on room and board, and then we have to pay $5,238.92 cash. Then for estimated personal expenses, we pay $4,070 in cash and our $3,364 cash payment for health insurance. That means that our remaining $58,341.07 spent from our college assets in junior year, and we spent around $16,672.93 from cash, job, savings, etc. Senior year, since we didn't save enough or invest enough, and assuming no aid, we have to spend $75,014 in cash from savings or jobs, something like that, and that's going to have to cover our full senior year. For a Harvard degree, you pay $189,641.07 from your college savings plan, in which you deposited only $2,640 plus $220 times 12 months times 18 years equals $50,160, and $110,414.93 from savings, work, etc., assuming no financial aid whatsoever. You could increase your monthly and initial contributions to cover this deficit or trade proactively to increase your percent return through strategies explained in Part 2. We did not adjust for inflating college costs after freshman year because our otherwise unspent college funds can remain in corporate bonds accruing an average 5% annual interest. In these bond investments, our funds will rise slightly above the historical average college inflation rate with minimal risk while we wait to pay for the remaining years of college. We will further explore bonds in Chapter 22. If you have 2 or more dependent children in college at once, then you can claim the larger American Opportunity Tax Credit against your tax liability, owed tax, since you can claim multiple $2,500 AOTCs when you spend $4,000 on tuition, unlike the once per return tuition and fees deduction against AGI income. Review your return with both options to see which one works best for you. The Lifetime Learning Credit is also a once per tax return credit against your tax liability. You can pay for anything you want as long as you plan for it. College, retirements, savings goals, and more are all within your grasp thanks to the power of the long-term American economy. By planning and investing in your child's college today, you can give them the best possible start in their adult lives without debt.